Basic principles of life and health insurance. The role of insurance is to transfer the risk of financial loss from an individual or business to an insurance company, which in turn spreads the cost of the unexpected financial loss to many individuals. If there were no insurance system, the cost of the loss would have to be borne solely by the person who suffered it. For example, life insurance guarantees a specific amount of money when someone dies. Health insurance provides funds to cover medical bills due to illness or injury, and also to cover the loss of money due to disability. Annuities provide a stream of income by making a series of payments over a set period of time. Insurance is available from both private and government companies. Private companies are also known as commercial insurance companies. They are funded through premiums and sell insurance for profit, while government programs are funded with taxes and serve national and state social purposes. The two most popular types of commercial insurers are stock companies and mutual companies. Stock companies. A stock insurance company is organized and incorporated under state law. They are owned by the shareholders, who get a paid share of the company's profits through dividends. Stock companies are also known as non-participating or peerless because policyholders do not participate in the payment of dividends. Mutual insurers. Mutual insurance companies are also organized and incorporated under state laws, but have no shareholders. Instead, policyholders own the company, and as owners, they receive a share of the company's profits through dividends. Mutual companies are also known as participating or par companies because the policyholders do participate in the payment of dividends. Mutualization. If a limited company decides to become a mutual company, the process is called mutualization. Demutualization. If a mutual company decides to become a joint stock company, the process is called dismutualization. Lloyd's of London. Lloyd's of London is not actually an insurance company, but rather an association formed to underwrite and issue insurance-like coverage on certain items and areas that otherwise could not be insured. Reinsurers. Reinsurers are a specialized branch of the insurance industry. They insure the risk of other insurance companies. Reinsurance is an agreement by which an insurance company transfers or sells a portion of the risk to a reinsurance company. The insurance company that transfers the risk is called seed capital company, and the company that assumes the risk is the reinsurer. Insurers of home services. Home service insurance is industrial insurance sold by home service or debit insurance companies. The nominal amounts are very small, usually $1,000 to $2,000, and the premium is collected weekly door-to-door by the agents. Service providers. Service providers offer benefits to subscribers in exchange for paying a premium. The most common providers are health maintenance organizations, better known as HMOs, and preferred provider organizations, better known as PPOs. Government insurance programs are offered through Social Security, Medicare, and Medicaid. How insurance is sold. Most consumers buy insurance from licensed insurance producers.
The companies of National Life Group offer index universal life insurance and fixed index annuity solutions that leverage index crediting strategies. So, let's take a look at how index crediting works.
Meaning they work for
These solutions have a component that credits interest based in part on changes in a major market index like the S&P 500. Why credit interest based on a stock market index? Two reasons, potential and protection. When the index goes up over the stated period, interest is credited. However, there is protection from an index decline with a feature called the floor. The floor allows zero to be your hero. Let's look at a couple examples. In this example, we will look at a point-to-point strategy. A point-to-point strategy calculates the interest based on a set period of time, such as 1 or 2 years. The beginning and end of the time periods
Insurance
of those 2
companies
points.
must notify
When the market is
applicants about the
positive,
credit
your
check
policy is
that will
credited
be
interest
conducted
after
on them
applying any
and allow
caps
them
and
access
participation
to a
rates. A
notification
cap
of anything
is the
that may
maximum
be found
annual
in the
account value
oversight of the
percentage
insurance
increase
industry.
allowed to contract
The
owners.
National
The
Association of
participation
Insurance
rate is the
Commissioners
percentage of
is
an
an
increase in
organization
an index
made up of
allowed to
insurance
contract
commissioners
owners.
from
In
all
this
50
example,
states,
the market has a
the
positive
District of
change of
Columbia,
10%.
and the
After
4
a
U.S.
cap of
territories.
8% and a
The NAIC
participation
is
rate of
responsible for
100% are
resolving
applied,
insurance
the policy
regulatory
realizes the
issues,
potential of the
as it
market
is
index
actively
up to the
involved in
cap of
shaping
8%.
and
What if
recommending
the index
insurance legislation, which is designed to achieve state-to-state uniformity and simplify insurance marketing. State surety associations protect policyholders in the event an insurance company goes bankrupt, becomes insolvent, or is unable to pay claims. Independent rating services. Independent rating services are independent credit rating agencies that rate the soundness and financial stability of insurance companies. Ratings are based on claims, reserves, and company earnings. Insurance is more than a contract. It is a safety net, a planning tool, and a key to financial stability. Understanding its principles, structures, and regulations is essential for both professionals and consumers, allowing for better decision-making and greater peace of mind. If you want to be part of our team,
contact us 209-898-0343. Insurance and Financial Services Agents. Hablamos Español. Visit us www.infiscgroup.com.